Hi, this is Dustin with Dustin's Dollars. Today I'm going to be talking about Tellurian, specifically about their price refresh data that they just released with their Q1 quarterly report. And I'm going to use that plus a couple other updates that came out from that Q1 report to update my Driftwood LNG Phase 1 cash flow model. And I will go through all of that today. Before I begin, though, let me remind you that I am not a financial advisor or a financial professional of any sort. All opinions that I express in this video are mine and do not represent those of any company or any other individual. I currently hold a long position in Tellurian, so basically this video should be for your entertainment purposes only, because I can be wrong about everything I say in this video. You need to do your own research before making any investment decisions. All right, so that being said, if you follow Tellurian at all, I'm sure you know that they released their Q1 earnings report. I have mostly skimmed through it. I have not read everything in super detail, so I will probably have at least a couple more videos covering some of the interesting tidbits that came out from that. But the one that is the most interesting to me that I wanted to cover is, well, first of all, there's obviously a lack of news about actual financing. So that's, was to be expected in the quarterly report, but overall, that's the number one thing that we really are looking for. But the number two thing is really the project economics on Driftwood LNG, and that is what we do have some new information about, and that's what I'm going to go over today. So we see this in the change order that was filed with the quarterly report. We finally got that price refresh, right? I had been using I had been talking about this where I don't think that the price that they had from the that was still from 2019 is valid anymore. Now we have concrete evidence of that, the concrete proof that that price was not valid. And you can see this right here. The parties agree that the contract price will be increased by 660 million US dollars and 71, almost 72 million euros. So when I added all of that up, that is an increase of about 750 million US dollars. And so that is an increase, I think, of roughly, let's say, call it roughly 10%, maybe just slightly under, I think. I'll get to that in a minute. But that was actually less than what I had been expecting, right? I had been using my base case for their price refresh, their increase in the price that I'd been using my prior models was 15%. And so the fact that it is only up by roughly 10%, I think is... it's less than I was expecting, so it is a positive in my mind for the economics of Driftwood LNG for phase 1. So that was good. And the other thing about this is that those, or let's talk about how long those prices were locked in for. And this is actually where I think it's less good. I'm not necessarily going to call it bad, but I'm going to go through this real quick. Is those prices were only locked in until May 1st of 2022, which was 4 days ago. And they had to issue the full notice to proceed to Bechtel in order for those prices to hold as, to go according to this contract. Since it doesn't seem, we don't know, at least if they've issued a notice to proceed to Bechtel. I'm guessing that they did, and I think we would have heard about that by now if they did. And so because they didn't, that does mean that Bechtel is entitled to an additional change order for external factors. And they have examples here. For example, closing of vendor shops, unavailability of materials, labor unavailability, ability to attract and or retain qualified labor, and owner-directed changes. There are some exclusions here, so that's good, right? It excludes impacts related to quantities, technology, equipment specifications, equipment count, or contractor errors or omissions. What is unclear to me, and again, I'm not a lawyer or an expert, so it's just going to remain unclear. It's sort of an unknown to me, is when they say it excludes impacts related to equipment specifications, equipment count. It's not obvious to me if increases in the cost of equipment are included. I have to imagine that they are, right? Because the examples that they have of things like unavailability of material, labor unavailability, those do sound like external factors, things that were outside of the control of Bechtel if the cost of steel goes up significantly, or the cost of whatever other materials they need goes up. As again, I haven't followed commodity prices too closely, and I don't know what they were looking at and they were projecting. So it's impossible to really tell. I think to even project whether the prices are higher than what they used in their model for this or not. But anyways, so that is the case, and they do have until March 31st, 2023 for all of these other factors to be locked in. So the risk is, as of right now, I think Bechtel is entitled to an additional change order due to external factors. So depending on how soon Tellurian is actually able to issue a notice to proceed, assuming that we get there, I think that might be a material impact here. But it was a little bit, again, the increase that we saw was less than I was expecting, given some of the inflation in commodities that we've seen. So maybe it's not as bad as I'm thinking it could be, since a good chunk of this is actually locked in until March 31st of 2023. Hopefully we're not waiting that long for a notice to proceed. So a couple other things I wanted to call out from the Q1 report is we did see the shares of common stock outstanding as of April 25th, 2022. There were 568 million shares of common stock outstanding. And then they also have the about 6 million preferred shares, and they have they also have the performance-based restricted stock that I've talked about this a little bit, where they have they said as of March 31st, 2022, they have 31 million shares of those performance-based restricted stock outstanding, basically shares that are going to vest when they hit FID or a year or two afterwards. So I added all that up. Hopefully I did my math right, and that gets me to about 605 million shares that are going to be relevant if we want to look forward to operations for Driftwood LNG Phase 1 and say what are our potential cash flows per share. That number matters, and that's an update to my model, which I'll get to in again just a moment, because previously I had been using 500 million shares outstanding, and now I'm using 0.6, 600 million shares outstanding. So that's it's not huge in the scheme of things, considering I had also modeled quite a bit of additional shares for the dilution for the equity portion of the costs to actually pay for Driftwood LNG Phase 1, but that still dilutes things a bit more, so it does matter. One other thing that I got from this report that I think I've talked about in the past, but I think I went even further to include it in the model here today. And then this is actually good just for them to confirm this to see that they're on track, that they are roughly at 100 million cubic feet equivalent per day of gas, and that they plan to reach 200 million cubic feet per day by the end of the year, right? And so that would be 0.2 BCF per day by the end of the year. Now, to remind you, Driftwood LNG Phase 1 needs 1.5 BCF per day of feed gas, if I have my numbers correct. So as of the end of this year, they'll have 0.2, and so that would be, slightly more than 10%. What I did today for my model was I was looking at, there's this concept of they're going to do their upstream production themselves, and that's going to allow them to control the cost of the gas. And at the current rate that they are, what I'm using for the model today is I'm looking at what if they do not acquire anyone and they use what they have now and they just grow their production at the same rate that they are expected to do this year, right? To increase by about 100 million cubic feet per day. And so if I assume they end 2022 at 0.2 BCF per day, that's where they would end the year in terms of production capacity. If they add another 0.1 BCF per day per year in 2023, 2024, and 2025, then they would end up with about half a billion, or half of a BCF per day in terms of production. And so that, if they need 1.5 BCF per day for feed gas for Driftwood LNG Phase 1, that lets them actually produce 1/3 of the gas that they need. So in my model, I'm going to go to I have sort of the scenario where they produce 1/3 of the gas that they need, and so that brings their cost down to that. So getting the actual model, these are the updates, right? So previously, this column B are the numbers that are listed in their most recent investor presentation, which is from, I think, November of 2021. That was a bit sad that we didn't see a new investor presentation coming with their quarterly report. They historically have done that, have done those together. I have to imagine that's because things are up in the air in terms of financing and all that such business. But for now, again, this is what the costs were in that presentation in November 2021 as examples, or as a, let's say, a sample model. This is my new updated estimate, right? We have the Driftwood LNG terminal. I increased that to the $8.5 billion as I sort of went through that change order previously that included that. And then these other numbers I put, I increased by just a bit, by like 10%, just to match the increase in the Driftwood LNG cost. Although overall, those, these are small compared to the overall cost needed for the actual contract with Bechtel. But overall, that gets me to a rough estimate that they're going to need $13 billion in capital. And if I go back over to my funding, my source, I sort of play with the numbers a little bit here to get exactly the 60% debt situation and the 70% debt situation, since they've sort of given that guidance in the past that they're shooting for between 60 and 70% of the project to be funded by debt for phase one. And so that gets us to these sort of numbers where Tellurian would need to contribute $5.2 billion, which, if you assume they do get some free cash flow from LNG production, it gets you down to about $4.3 billion that they would need to actually dilute in order to fund in the 60% case. And going through a similar exercise for the 70% case, you need about $3.15 billion there in dilution, or being raised from equity somehow, which again, this is a simple model for dilution. And so I have this model here. Let's bring this back down to $5 for a share price for dilution. Sorry, that was an update I meant to do before this. And so if we look at this, right? So we have their column B and column D are their numbers that they have as an example in their investor presentation. You have the sales price of the gas, JKM less transportation. That's their example marker. Subtract off the cost of the gas, whatever it takes you to source that gas. Subtract off the liquefaction cost and the transport, and then you are left with your margin. That's their actual profits. Multiply by 550 for the BCF, for the actual capacity of the plant, and then you get your sort of annual cash flows in just absolute dollar value. And then I have the model here both for the 70% debt situation and the 60% debt situation in terms of what are the interest payments. I have just a line item here for the OPEX and SG&A to subtract that off. And then I have a rough estimate of what their overall, again, cash flow is in absolute dollars. And then I divide that by the estimated share count, given how much dilution is needed at this particular share price to cover the remainder that is not funded by debt. So I know that was a lot. That's how my model it works out. Feel free to rewind it if you want to rewind it, or pause the video if you want to look through that. Hopefully it all made sense to you. And this is what it looks like if they just purchase gas off of the market. We're looking at about, in the 70% debt situation, $2.07 free cash flow per share. In the 60% debt case of about $1.85. And then if they were able to do the production themselves, right, and that actually lowers the net effect is that it lowers their cost of the gas that they have to get. And they think they can produce for $2 per MMBTU. And in that situation, obviously your cash flows are higher because you're not paying as much for the gas. That gets your free cash flow per share, again, between the 60 and 70% situation, somewhere between 260 and 296 free cash flow per share. Again, these are just a sample model. What I added in here is this column C, which is which is a situation where they actually produce 1/3 of their gas, because that seems like the current trajectory that they're at with the wells that they're drilling. So if they did that, brings their gas sourcing costs down a little bit, and that gets you, it increases your free cash flow per share versus the just buying it off the market by about looks like maybe 15% or so. You can see the numbers here, about 237 per share or 210 per share, somewhere in that range. Now, the one thing that I was going to note, and why I put this upstream production column in red, is that I think in order for them to get, to acquire some upstream assets, they would have to, I assume, dilute for that. I don't think that's just my guess, right? They're going to have so much debt that they're for Driftwood that it's unclear to me that they would be able to get a lot of debt financing to acquire an upstream company or upstream assets of some sort. So I think that one's a lot harder for me to just model out as is, because I think there's some additional financing component that really needs to be included, and it's really hard to predict that. However, given what we've seen, that they are actually drilling wells and they are increasing their natural gas production right now, I do think it's reasonable for them to have to achieve this situation where they're producing 1/3 of what they need for Driftwood LNG Phase 1 without any particular dilution, without having to go get financing or anything else, because that just seems to be the trajectory that they're on if they continue that all the way until 2026. So that is my model here. Again, we're looking at maybe $2.10 to 237 free cash flow per share, given sort of the trajectory as I see things right now. Again, hopefully I've gone over all the assumptions that I have baked into this model. Feel free to, let me know what you think. Let me know how you model this out in the comments. I'd be interested to hear how other people do this. I'm kind of doing it on my own. Again, not being a professional, just an individual retail investor. This is how I'm thinking about it. The one other thing that I did want to call out here is, if you're still watching, you probably might care about the details and some speculation. They actually signed this change order. They executed this on March 30th, 2022, right? So they have this date here. It's spelled out for us. And the fact that they signed this at the end of March and are putting in dates for their, the bid validity until May 1st, which was effectively only a month's time frame, that's actually interesting. And I think you can look at the optimistic, is the glass half full or half empty, right? The optimistic take here would be that they thought that they were going to close the financing and actually be able to issue the notice to proceed sometime, sometime in April or on May 1st, right? They actually, that's the optimistic, that's the bullish take, is that they thought they were so close to getting the financing, and maybe there was some amount of small delay, but that maybe they're like right on the cusp right now. I think the pessimistic take is the converse of that, which is, well, they weren't actually able to get the financing. They weren't able to issue the notice to proceed by May 1st, and then you have to ask why. And there's a whole bunch of answers to that you could, you can make a bearish case from, the other potential, bearish case now is that because they weren't able to do that, then the costs could go up. As I mentioned before, these prices were only locked in until May 1st. So now maybe this is open to some additional, reevaluation of the cost, additional change order. And then maybe that has an impact again on the financing of delaying that process even further, because now they need a different amount of money. And so I think that's, that would be the pessimistic take on this. Generally at this point, I have to imagine, they wouldn't have bothered with the change order, only extending it by a month if that wasn't going to be, useful to them. So we'll see. Time will tell, right? It's a waiting game at this point. So I am, as of now, continue to hold my shares as I've held them for quite a while. I'd be curious to hear what y'all think. So that is what I wanted to cover today. Let's see, is there anything on the chat? Nope, nothing on the chat. Just if you are still watching all the way to this point, I do these videos usually late in the day late in the evening, I would say, 10 p.m., 11 p.m. or so, in Eastern U.S. time. And I do them usually almost always live. So I'd be happy folks are want to hop on and join the chat and give me some feedback or give me your thoughts, questions, whatever. Anyways, that is all. Thank you very much for watching and have a good one. Oh, I got something on the chat. Real quick. Brian. Hi, Brian. Great catch about the issue date. Oh, thanks. Yeah. I I was looking through that and I noticed that. So yeah, the one other thing, so this is total speculation, right? The other thing I was wondering is maybe cross my fingers, try to be the eternal optimist here, wondering, is it possible that they could have actually issued the notice to proceed and we didn't know yet, right? That they hadn't actually disclosed it. And I think that was plausible as of yesterday, but probably not anymore. I think my understanding is that they would have had to have 4 days to disclose that, and because I think that's a material event that they would have had to disclose that. So unfortunately, that I don't think panned out. See what else could that be because of the Fed rates increase? Speculating here about timing that. I don't know. Yeah, that's kind of over my head. I have no idea how the Fed rate increase would impact this stuff. I think it could, right, if that's impacting the bank side of things, right, where they were maybe ready to get everything ready, and then the bank said, hang on, we we have to redo this because that impacts our how the banks are structuring their deals and actually getting stuff. So that's a good point. I don't know. I have no nothing to add there, but it's a good call out that could have definitely impacted things here as to why they weren't able to actually get this closed. And I mean, I sure hope that that's not the case, because I think that the Fed has been, well, I'm not an expert, but it seems like it's a bit unpredictable at this point. So if that's one of the things that's a major factor here, that makes me worried about their the process of getting financing. But hopefully they can close it soon. I personally still have at least some faith in Sharif Suki, and when he did say this is easy, I can't imagine that he said that just for effect, right? I have to believe that there's at least some kernel of truth to him saying that the financing process was easy, or what was one of the easiest things he's done, right? I think that was the actual quote. So thank you, Brian. Thank you for tuning in. Thank you for the comments there. I appreciate it. So all right, I'm gonna hop off now. Thank you, everybody.